Let me tell you about the most expensive education in America, and it has nothing to do with college tuition. It's the education that happens when a retiree discovers, usually in the middle of a tax appointment or a conversation with a financial advisor, that a decision they made 1, 2, or even 5 years ago triggered a tax consequence they never saw coming. A missed required minimum distribution that triggered a 25% penalty. A large IRA withdrawal taken in the wrong year that pushed their Social Security into the 85% taxable tier. A Roth conversion done without accounting for IRMAA that raised their Medicare premiums by $800 a month 2 years later. An inherited IRA that sat untouched for 6 years before the beneficiary learned about the 10-year withdrawal rule and suddenly faced a massive tax bill on everything that should have been distributed annually. These aren't rare stories. They happen to informed, intelligent, careful retirees every single year simply because nobody walked them through the 7 specific IRS retirement tax rules that govern how retirement income actually works. Until today. This is Professor Kingsley, and we are going through all 7 of them in plain language, one by one. By the end of this video, you will understand the rules that most seniors only discover after the mistake has already been made. Stay with me all the way through. Welcome to Professor Kingsley. This is the channel where we take the tax and financial rules that matter most to retired Americans and explain them the way a knowledgeable, trusted friend would clearly, honestly, and in language that actually makes sense. If you're new here, please hit that subscribe button right now and turn on the notification bell. We put out new content every week, and the 7 rules we're covering today are exactly the kind of information that should be in every retirement planning conversation, but rarely is. Subscribe, and let's get into all 7. The first IRS retirement tax rule that most seniors learn too late is the one that generates the largest single transaction penalties of any rule in this list. It governs required minimum distributions specifically, the age at which they begin, the deadline by which they must be taken, and the penalty for missing them. Required minimum distributions are the minimum amounts you must withdraw from your retirement accounts each year. You generally must start taking withdrawals from your traditional IRA, SEP IRA, Simple IRA, and retirement plan accounts when you reach age 73. You can withdraw more than the minimum required amount. Your withdrawals are included in taxable income, except for any part that was already taxed or that can be received tax-free. Your first RMD must be taken by April 1st of the year after you reach age 73. If you wait until April 1st for your first RMD, you'll also need to take your next RMD by December 31st of that same year. That means 2 taxable withdrawals in 1 calendar year. This double distribution trap in the first year is one of the most consistently costly mistakes in all of retirement planning. A retiree turns 73 in 2025. They learn they can technically delay their first RMD until April 1st, 2026. They do. And then someone tells them, perhaps too late, that their second RMD for 2026 is also due by December 31st, 2026. 2 full taxable distributions in the same calendar year. Doubled taxable income in 2026. Potential bracket jump. Potential Social Security taxation increase, potential IRMA trigger for Medicare premiums in 2028. All from a decision that seemed reasonable, taking advantage of the April 1st delay without understanding what it actually cost. Most tax professionals recommend taking your first RMD in the actual year you turn 73, precisely to avoid this compounding effect. The penalty for missing an RMD is 25% of the amount not withdrawn. If the shortfall is corrected during the correction window, the penalty can be reduced to 10%. If your shortfall is $5,000, the 25% penalty is $1,250. If the 10% rate applies, the tax is $500. And the calculation for how much you must withdraw is based on a specific IRS formula. Your RMD is calculated by taking your account balance on December 31st of the previous year and dividing it by the applicable denominator in the IRS Uniform Lifetime Table. For example, if you have $100,000 in a traditional IRA and you're 73 this year, you divide $100,000 by 26.5 to get an RMD of about $3,774. You'd repeat this process for all other tax-deferred retirement accounts. Know your RMD. Know your deadline. Know the penalty. And if you've already missed a distribution, even in a prior year, take action now through Form 5329. Correct the shortfall and pursue the 10% reduced penalty rather than the 25% full penalty. The second IRS rule that most seniors learn too late involves multiple retirement accounts, and specifically, the rule difference between IRA accounts and 401k accounts when it comes to taking RMDs. The rules for applying IRS RMD requirements across multiple accounts differ significantly by account type. For traditional IRAs, you may total the RMDs for all IRA accounts and withdraw from any one or a combination of them. For 401k accounts, RMDs must be taken separately from each 401k. Roth IRAs have no RMDs for original owners, even in 2026. This rule distinction catches a lot of retirees because they assume the flexibility they have with IRAs applies to all their retirement accounts. It doesn't. If you have two old 401k accounts from former employers, which is common for people who change jobs throughout their career, you cannot calculate the combined RMD and take it all from one of those accounts. You must calculate and take the RMD from each 401k separately. Fail to take the RMD from even one of those accounts, even if you took more than enough from the others, and you've missed that distribution and triggered the penalty. The simplest solution for people with multiple old 401k accounts is consolidation, rolling them into a single traditional IRA, which then gives you the flexibility to calculate a combined RMD and take it from any account you choose. Consolidation also simplifies record keeping, reduces the risk of a missed distribution, and makes long-term planning cleaner. If you have old 401k accounts sitting with former employers, it's worth discussing with a financial professional whether consolidating them makes sense for your situation. Also important to know, Roth 401k plans, the Roth designated accounts inside employer-sponsored retirement plans, are now also free from RMDs during the original owner's lifetime. This change, which took effect recently, brings Roth 401k plans in line with Roth IRAs. However, RMDs still apply to inherited Roth accounts once they pass to beneficiaries. This is a meaningful change for anyone who has been making Roth contributions inside a workplace plan and was wondering whether those funds would be subject to RMD rules. They are not during your lifetime. The third rule that most seniors discover too late is one that involves the intersection of RMDs and Social Security, and it creates what tax professionals have come to call a tax torpedo that can silently push effective tax rates on retirement income far above what people expect. If you don't need the RMD funds and are just taking them to avoid a tax penalty, you could find yourself facing a higher tax bill than expected. Your RMD adds to your income for the year, which can affect how much of your Social Security benefits are taxable. RMDs are fully taxable at ordinary income rates, which can push retirees into higher tax brackets and trigger additional taxation on Social Security benefits and Medicare premium increases. Large RMDs can cause your modified adjusted gross income to exceed thresholds, triggering significant Medicare premium surcharges. Here is how the chain reaction actually works. Your RMD goes into your adjusted gross income. That higher AGI goes into the provisional income formula that determines how much of your Social Security is taxable. And if that same income pushes your modified adjusted gross income above the IRMAA thresholds, your Medicare Part B and Part D premiums in 2 years increase significantly. So a single large RMD creates 3 separate tax consequences: ordinary income tax on the RMD itself, additional Social Security taxes triggered by the higher income, and elevated Medicare premiums 2 years later based on that year's MAGI. Strategic RMD timing and QCD utilization can prevent this costly outcome. Qualified charitable distributions reduce AGI dollar for dollar without triggering IRMAA increases, making them doubly valuable for retirees managing Medicare costs. Understanding this chain reaction before it happens, rather than after, is the difference between proactive planning and reactive regret. If your RMDs are going to create income you don't need for living expenses, 2 tools specifically address this: QCDs, which convert the RMD into a charitable gift with no income tax impact at all, and Roth conversions done in the years before RMDs begin, which permanently reduce the future RMD balance and therefore permanently reduce the future tax chain reaction. The fourth rule is one that billions of dollars in retirement assets are affected by, and that most beneficiaries of inherited retirement accounts discover only after they've already made expensive mistakes. It's the 10-year rule for inherited IRAs created by the Secure Act. For defined contribution plan participants, or IRA owners, who die after December 31, 2019, the entire balance of the deceased participant's account must be distributed within 10 years. There's an exception for a surviving spouse, a child who has not reached the age of majority, a disabled or chronically ill person, or a person not more than 10 years younger than the employee or IRA account owner. Secure Act rules significantly changed RMD requirements for non-spouse inherited IRAs. Missing or miscalculating an RMD from an inherited account can trigger penalties of up to 25%, reduced to 10% if corrected promptly. The typical scenario that creates disaster here is the adult child who inherits a parent's traditional IRA. Before the Secure Act of 2019, that beneficiary could stretch the distributions across their own life expectancy, taking small distributions over decades and deferring the tax burden accordingly. After the Secure Act, most non-spouse beneficiaries must empty the entire account by December 31st of the 10th year after the original owner's death. 10 years. Total withdrawal. Everything taxed. What catches people is the assumption that the 10 years gives them total flexibility, that they can simply take everything in year 10 as one large distribution. IRS guidance has clarified that in many cases, annual distributions may still be required during the 10-year window, particularly if the original account owner had already started taking RMDs before death. Missing those annual requirements triggers the penalty on each year's shortfall. If you have recently inherited an IRA from a parent, grandparent, or anyone other than a spouse, please talk to a tax professional or financial advisor before you withdraw a single dollar. The rules are complex enough that the cost of 1 hour of professional guidance is almost certainly less than the cost of an uninformed distribution decision. The fifth rule is one that creates one of the most frustrating and avoidable tax surprises in retirement, and it's a rule most people have simply never heard of. It's the way the IRS calculates how much of your Social Security benefit is taxable, using a formula called provisional income. Social Security is the most misunderstood line item in retirement taxes. The IRS explains that benefits may be taxable when 1/2 of the benefits plus other income goes above the base amount for the filing status. For many seniors, Social Security was not taxable for years, then suddenly becomes partly taxable after a pension starts, a spouse dies, or IRA withdrawals increase. The thresholds that determine taxability are $25,000 for single filers and $32,000 for married couples filing jointly, below which Social Security is completely tax-free. Above those levels, up to 50% of benefits become taxable. Above $34,000 for singles and $44,000 for married couples, up to 85% of benefits are subject to federal income tax. And here is the rule that most people don't know and that creates the biggest surprise. These thresholds have not been adjusted for inflation since 1983 for the lower tier and since 1993 for the upper tier. Not once, not even slightly. As a result, more and more retirees cross them every year, not because they got wealthier, but because their income grew naturally with inflation, while the thresholds sat frozen for decades. The practical implication: every additional dollar of IRA income you take in retirement doesn't just add a dollar to your taxable income at your marginal rate. It may also drag additional Social Security income into taxability at the same time, creating an effective marginal rate that is far higher than your stated bracket. Tax professionals call this the tax torpedo, and learning about it after years of taking large IRA distributions is one of the most frustrating "I wish I'd known" moments in retirement planning. The strategies that address this are the same strategies we've discussed throughout this video: QCDs, that remove IRA income from your AGI, Roth conversions done in lower income years before Social Security is claimed or before RMDs begin, and careful withdrawal timing to stay within the lower provisional income tiers. The sixth rule is one that has changed significantly in recent years, and that creates serious planning errors for seniors who haven't checked in on their Roth IRA rules since the account was first explained to them decades ago. It's the 5-year rule specifically, the rules governing when Roth IRA conversions and contributions can be withdrawn tax-free. Roth IRAs work differently from traditional IRAs. Because Roth IRAs are not subject to RMDs during the original owner's lifetime, some retirees explore Roth conversions well before RMD age as part of a comprehensive retirement planning approach. Here's the rule that trips people up. When you convert money from a traditional IRA to a Roth IRA, that converted amount has its own 5-year seasoning period before it can be withdrawn penalty-free if you're under age 59 and a half. But if you're over 59 and a half, which the majority of people doing retirement Roth conversions are, the 5-year rule works differently. Each conversion's earnings may be subject to a 5-year holding period to be tax-free, but the principle of a conversion done when you're over 59 and a half is generally accessible without the 10% early withdrawal penalty from the moment of conversion. The more important 5-year rule for seniors is this. The entire Roth IRA must have been established, meaning you must have made your very first Roth IRA contribution or conversion at least 5 years before you take any qualified distribution for it to be fully tax-free. So if you open your very first Roth IRA at age 70 through a conversion, and you withdraw from it at age 72, that withdrawal may not meet the qualified distribution standard yet. The 5-year clock needs to run from the first year any Roth IRA was opened in your name. The practical takeaway? If you're considering Roth conversions as part of your retirement tax planning, open a Roth IRA now, even with a small amount to start that 5-year clock running. Don't wait until your first large conversion to establish the account. Time is the resource here, and starting the clock early is completely free. The 7th rule is the newest one on this list, and it's one that a meaningful number of retirees are miscalculating right now specifically. The interaction between the new enhanced senior deduction and the modified adjusted gross income calculation that governs Social Security taxation and Medicare premiums. Effective for tax years 2025 through 2028, individuals age 65 and older may claim an additional $6,000 deduction on their federal income tax return, in addition to the standard deduction for seniors already available under existing law. The deduction is $12,000 for a married couple where both spouses qualify. It phases out for modified adjusted gross income over $75,000 for single filers and $150,000 for joint filers. The specific confusion that is causing real planning errors right now is the assumption that this deduction reduces your modified adjusted gross income, the number used for the Social Security Provisional Income Test, and the IRMAA Medicare premium determination. It doesn't. The enhanced senior deduction is a below-the-line deduction, meaning it reduces your taxable income, the number on which your actual tax bill is calculated. But it does not reduce your AGI or your MAGI. This means the $6,000 deduction will reduce the tax you pay on whatever Social Security is already determined to be taxable. But it will not change how much of your Social Security is determined to be taxable in the first place. And it will not change whether you cross an IRMA threshold that raises your Medicare premiums 2 years from now. Do not assume retirement income is tax-free just because wages stopped. Older adults often have several income streams, and one can change the tax treatment of another. Social Security is the most misunderstood line item. For many seniors, Social Security was not taxable for years, then suddenly becomes partly taxable after a pension starts, a spouse dies, or IRA withdrawals increase. Retirees who are adjusting their tax withholding or estimated payments for 2026 based on an assumption that the enhanced senior deduction reduces their MAGI are making a mistake that will show up as a surprise tax bill. The deduction is valuable and real, but it operates at the taxable income level, not the AGI level, and understanding that distinction is essential for making accurate projections. Now let me pull all 7 rules together into a practical checklist, because the whole point of understanding these rules is to make sure they don't catch you by surprise. Rule 1. Know your RMD age, deadline, and penalty. You must start at 73. Your first RMD is due by April 1st of the year after you turn 73, but taking it in the year you turn 73 avoids the double distribution problem. The penalty for missing an RMD is 25% of the shortfall. Rule 2. Know how multiple accounts are treated differently. You can aggregate and take RMDs from any of your traditional IRAs, but 401k accounts require separate distributions from each one. Roth IRAs and now Roth 401k plans have no RMDs during the original owner's lifetime. Rule 3. Understand the RMD chain reaction. Every dollar of RMD income adds to your AGI, which adds to your provisional income for Social Security taxation, and which adds to your MAGI for IRMAA Medicare premium determination 2 years later. QCDs and Roth conversions are the primary tools for managing this chain. Rule 4. If you've inherited an IRA, consult a professional before making any distribution. The 10-year rule, the annual distribution requirements if the original owner had already started RMDs, and the inherited Roth rules are all complex enough to warrant professional guidance. Rule 5. Learn the provisional income formula. Your Social Security taxation is determined by a formula the IRS has not updated for inflation since the 1980s. The thresholds are low. The interaction with IRA withdrawals creates a tax torpedo effect that drives effective rates higher than the stated bracket suggests. Rule 6. Start your Roth IRA 5-year clock early. If you haven't opened a Roth IRA yet and you're considering conversions, open one now, even with a small amount, so the seasoning period begins. Rule 7. Understand what the enhanced senior deduction does and doesn't do. It reduces taxable income, not MAGI. It reduces your tax bill on Social Security that's already been determined to be taxable. It does not change the provisional income calculation that determines how much of your Social Security is taxable in the first place. These 7 rules represent the gap between the retirement tax education most people receive and the retirement tax reality most people actually face. Every one of these rules has created a costly surprise for a real retiree who had been doing everything else right. And every one of them is entirely preventable with the right information at the right time. You now have that information. Use it. Share it. Before you close this video, hit that share button and send this to one person in your life who is retired or approaching retirement. A parent, a friend, a neighbor, a sibling. The 7 rules we covered today are exactly the kind of information that could save them from a painful and expensive discovery that comes too late. 3 seconds to share. Real financial consequences as the result. It's worth doing. And drop a comment below. Tell me which of these 7 rules surprised you the most. Are you approaching RMD age and thinking about the strategies for the first time? Have you inherited an IRA and are now wondering about the 10-year rule? Are you in the RMD years already and feeling the chain reaction we described? Tell me where you are. I read every comment, and this community helps shape every video I make. This is Professor Kingsley. Learn the rules before they learn you, and I'll see you in the next one.